and then I'm going to grab the YouTube or the Twitter feed for this, and then send it to CoinDesk.
Good.
Check 1 2, check 1 2.
Not very many power credits. Looks like not as much curtailment.
Or audio does come through. Hello. Yo, 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 yo. Welcome back to the Mining Pod live stream. We're doing Riot's Q3 updates. We got a lot of people in the chat so far. There looks like 500 viewers. Who knows what that means? It's Elon's Twitter now. We got a lot of
Those
people
are
here.
500 bona fide mining
Bots.
stock fiends.
That's one for each
They
megawatt.
live, eat, and breathe trading mining stocks.
So many bots in the chat, but we do have some fan favorites. See Penny, shout out to Penny Ether, one of our favorite analysts over here at Mining Pods / Blocks Space. Benjamin, I'm not familiar with you, but yes, earnings news is coming.
News is very much coming, and we've got the live stream pulled up. We appreciate y'all joining. They've still got the waiting room music going on in the live stream, a little bit of teasing us, seeing what's going to be going on with their presentation here shortly. Oh, looks like it's about to start.
This is audience interactive. So if you have a comment, hop onto the YouTube side and drop a comment. We may highlight it during their earnings call.
Also on Twitter, you can comment there.
All right. Conference call is kicking off.
Capital Markets and Investor Relations at Riot Platforms. Please go ahead.
Thank you, Liz. Good afternoon, and welcome to Riot Platforms' third quarter 2024 earnings conference call. My name is Phil McPherson, Vice President of Capital Markets and Investor Relations, and joining me on today's call from Riot are Jason Les, CEO, Colin Yee, CFO, and Jason Chung, Executive Vice President and Head of Corporate Development and Strategy. On the Riot Investor Relations website, you can find our third quarter 2024 earnings press release and accompanying earnings presentation, which are intended to supplement today's prepared remarks and which include a discussion of certain non-GAAP items. Non-GAAP financial measures provided should not be considered as a substitute for or superior to the measures of financial performance prepared in accordance with GAAP and are included as additional clarifying items to aid investors in further understanding the company's third quarter performance. During today's call, we will be making forward-looking statements regarding potential future events. These statements are based on management's current expectations and assumptions and are subject to risks and uncertainties. Actual results could materially differ due to factors discussed in today's earnings press release, in comments and responses made during today's call, and in the risk factors section of our Form 10-K and Forms 10-Q, including for the quarter ended September 30, 2024, which will be filed later today, as well as other filings with the Securities and Exchange Commission. With that, I will turn the call over to Jason Les, CEO of Riot Platforms.
Thank you, Phil, and good afternoon, everyone. Riot's primary strategic focus has been on developing a leading vertically integrated Bitcoin mining company built on the three key pillars of developing and owning operations of significant scale, being a low-cost producer of Bitcoin, and building a balance sheet of strength. During the third quarter of 2024, we continue to demonstrate success at all three of these pillars. Riot increased total deployed hash rate quarter over quarter by 27%, from 22 exahash to 28 exahash, meeting our quarter-end target of 28 exahash and on track to reach 35 exahash by the end of the year. The third quarter of 2024 was the first full operational quarter of Bitcoin production following the halving event, which occurred in late April, and which led to a reduction in the Bitcoin block subsidy from 6.25 to 3.125 Bitcoin per block. Additionally, global hash rate grew by 4% quarter over quarter. Both of these events created bearish headwinds for Bitcoin miners in relation to the cost to mine. Despite these events, Riot's cost to mine in the third quarter, aided by our unique power strategy, positions among the lowest cost miners in our industry and was significantly below the average price per Bitcoin during the quarter. We generated $12.4 million in power credits during the quarter, lowering our all-in cost of power to 3.1 cents per kilowatt hour during the third quarter.
Pretty low
curtailment, also supporting the Texas grid during times of disruption in supply and demand. During the third quarter, Riot also continued to address challenges regarding our operational hash rate. At this time is on improving this metric and reaching a standard of operational excellence. During the quarter, we completed the redeployment of a large portion of the underperforming miners at our Rockdale facility with a nameplate capacity of 3.33 exahash, and the subsequent installation of latest generation miners with a nameplate capacity of 3.66 exahash from May through September. This focus on improving operational efficiency is already beginning to show results, and we are pleased to report that through October 29th, Riot's Bitcoin production for the month was approximately 469 Bitcoin. Average operating hash rate through this period was approximately 23 exahash. And when excluding the first 2 days of the month when our Corsicana facility was powered down for substation maintenance, average operating hash rate was approximately 24 exahash, representing an over 80% company-wide average utilization rate. These are just initial and preliminary results from our focus on achieving operational excellence. And we believe that with the initiatives underway across all of our sites, we are strongly positioned to continue building on this positive momentum. We remain focused on the growth and enhancement of our Bitcoin mining business. Riot's focus is maximizing Bitcoin mining results, and our strategy is enabling us to execute on this at an unprecedented scale. I would now like to turn the call over to Colin Yee, CFO of Riot Platforms.
Thank you, Jason. I'm excited to present Riot's financial results for the third quarter of 2024. For ease of reference, and something you can always refer back to, is slide 5.
To announce these
This
financial
presents
results.
a snapshot of key financial and operating metrics for the third quarter of 2024. However, let's jump into the details on the following slides. Riot owns and operates the largest dedicated Bitcoin mining facility in the world, the Rockdale facility, where we continue to deploy miners and expand our self-mining capacity during the third quarter. In addition, Riot continues to add hash rate at our Corsicana facility, which, when fully developed, will supplant the Rockdale facility as the largest dedicated Bitcoin mining facility in the world. As a result of the successful development of our Corsicana facility and ongoing development at our Rockdale facility, Riot ended the third quarter with an installed hash rate of 28 exahash, a 159% increase relative to the third quarter of 2023, and meeting our guidance for the quarter. During this quarter, Riot mined 1,104 Bitcoin, in line with the 1,106 Bitcoin we mined during the third quarter of 2023. These results came about in spite of the Bitcoin block subsidy halving event, which occurred in April 2024, and the significant increase in the Bitcoin network difficulty, which increased by 59% from the third quarter of 2023. In spite of these events, and driven by the significant growth in our hash rate capacity expected through the remainder of the year, we anticipate producing more Bitcoin per day by the end of 2024 than we did in the first quarter of 2024, halving notwithstanding. Riot ended the third quarter of 2024 with 10,427 Bitcoin, an increase of 42% relative to the 7,327 Bitcoin that we held at the end of the third quarter of 2023. Riot continued to retain 100% of all Bitcoin produced in the third quarter. In the third quarter of 2024, Riot reported total revenue of $84.8 million as compared to $51.9 million for the third quarter of 2023, a 65% increase year over year. This increase was primarily driven by higher Bitcoin prices. Gross profit for the quarter was $24.3 million as compared to gross profit of $37.7 million in the third quarter of 2023. Non-GAAP adjusted EBITDA for the quarter was a loss of $3.6 million, as compared to non-GAAP adjusted EBITDA loss of $3.1 million in the third quarter of 2023. Riot adopted FASB's final standard on crypto assets issued in December 2023, under which Riot now recognizes its Bitcoin held at fair value, and with it, changes in fair value are now recognized in income. As a reference, the Bitcoin price at the end of the second quarter in 2024 was $62,678, and the price at the end of the third quarter was $63,330. This resulted in a mark-to-market upward adjustment of $8.6 million in the third quarter. Net loss for the quarter was $154.4 million, or 54 cents per share, compared to net loss of $80 million, or 44 cents per share for the same period in 2023. This quarter's net loss includes non-cash stock-based compensation expense of $30.6 million, unrealized loss on marketable equity securities of $38.1 million, and depreciation and amortization of $60 million. As a reminder, beginning in the first quarter of 2024, we adjusted our depreciation schedule for mining hardware from a 2-year to a 3-year schedule based on our evaluation of our own operational history. For the third quarter of 2024, Bitcoin mining revenue totaled $67.5 million, a 116% increase relative to third quarter 2023 Bitcoin mining revenue of $31.2 million. Bitcoin mining cost of revenue primarily consists of direct production costs of Bitcoin mining operations, including electricity, labor, and insurance, but excluding depreciation and amortization. Bitcoin mining gross profit for the quarter was $28.4 million, representing a margin of 42%, as compared to $56.4 million, or a margin of 181% in the third quarter of 2023. In spite of the global network hash rate increasing from an average of 604 exahash in the second quarter of 2024 to 625 exahash in the third quarter, a 4% increase, and the Bitcoin halving event in April of 2024, Riot's cost to mine Bitcoin in the third quarter increased by only 40% on a per Bitcoin basis when compared to the previous quarter. Cost to mine, excluding depreciation, this quarter totaled $35,376 per Bitcoin, of which power costs amounted to $26,673 per Bitcoin, or 75% of the total cost per Bitcoin. Quarter over quarter, power costs increased from 2.7 cents a kilowatt hour to 3.1 cents a kilowatt hour, as a greater portion of power was procured at the Corsicana facility at spot market rates, with proportionally fewer offsetting power credits than the previous quarter. We remain pleased with achieving an all-in cost of power of 3.1 cents a kilowatt hour, which remains one of the lowest in the industry. Direct non-power costs, which include direct labor, miner insurance, miner and miner-related equipment repairs, land lease and related property taxes, network costs, and other utility expenses, totaled $8,703, or 25% per Bitcoin mined, down from the second quarter of 2024, when direct non-power costs accounted for 41% of total costs. This significant drop is a result of Riot continuing to achieve economies of scale at our operating facilities. As Riot continues to grow hash rate, we expect to see non-power direct costs as a percentage of total cost per Bitcoin to trend lower. Riot's engineering business, carried out through Riot's wholly owned subsidiary, ESS Metron, reported revenue of $12.6 million in the third quarter of 2024, as compared to $15.5 million for the same 3-month period in 2023, a decrease of $2.9 million. This decrease was primarily attributable to one large government contract that had taken longer than anticipated to complete due to supply chain constraints. This resulted in an engineering gross loss for the quarter of $0.9 million, as compared to gross profit of $2.3 million for the third quarter of 2023. Our custom electrical products such as switchgear and power distribution centers are important components in data center development and in power generation and distribution facilities. And there has been increased demand for these products due to the continued increase in data center construction by developers, as well as the continually increasing worldwide demand for power. At the end of the third quarter, this large government contract finally shipped, freeing up approximately 1/3 of our warehouse capacity and allowing this division to get back to work on higher margin contracts. Riot's cash SG&A expense for the third quarter was $36.4 million. This cash SG&A expense figure includes one-time M&A and one-time litigation-related expenses of $4 million and $4.9 million, respectively, which puts our run rate cash SG&A for the third quarter at $27.5 million, in line with our previous guidance of $25 to $27 million per quarter, particularly when factoring in additional costs from Kentucky, which added a little over $700,000 in additional business and compensation expenses in the third quarter. For the fourth quarter of 2024, we expect run rate cash SG&A to come out in the $27 million to $30 million range. M&A and legal expenses are challenging to forecast, but based on current litigation activity levels, we anticipate litigation expenses in the fourth quarter will be significantly elevated relative to the third quarter. I will now turn the call back over to Jason Les.
Thank you, Colin. With Riot's recent expansion into Kentucky, we now have a direct pathway to 2 gigawatts of total power capacity and are well on our way to securing enough capacity to achieve our growth target of 100 exahash of self-mining hash rate. The pipeline that will ultimately enable this growth consists of 700 megawatts of capacity at our Rockdale facility, 1 gigawatt of capacity at our Corsicana facility, and more than 300 megawatts in Kentucky. Today, we are pleased to announce we have initiated the full second phase development of the Corsicana facility, which will add 600 megawatts of capacity when complete and take the site to 1 gigawatt of capacity. We have placed orders for the long lead substation equipment and expect the development to be fully completed in 2026. Riot has long strived to provide clear guidance on our growth plans, and just as importantly, where we anticipate this growth will come from. We believe that providing visibility on not just overall growth plans, but also on the specific path to achieve our growth plans is a vital element in demonstrating the credibility of any Bitcoin miner's growth forecast. Through our vertically integrated strategy, we have developed multiple pipelines of organic growth opportunities available for us to pursue. These expansion opportunities are at various stages of development and can be prioritized or pushed back based on our assessment of the optimal distribution of resources for our portfolio of infrastructure at any given time. Going forward, we intend to present our growth targets on a more conservative basis, based on a higher degree of confidence and internal prioritization level relative to our prior methodology. We believe that this approach will position us to more confidently meet and exceed expectations. Therefore, and with this revised approach in mind, we are revising our hash rate growth forecast for 2024 and 2025. For 2024, we now estimate a year-end installed hash rate of 35 exahash, down slightly from our prior guidance of 36 exahash. This adjustment is primarily driven by a 1.8 exahash decrease in expected hash rate growth in Kentucky, which is being pushed back into 2025, offset by a 1.1 exahash increase in expected hash rate growth at our Rockdale facility, resulting from initiatives underway to improve our operational efficiency. More specifically, we have accelerated and converted our MicroBT purchase orders for 2025 into 2024, with the planned delivery of approximately 8 exahash of M60 miners in the fourth quarter of this year. Since our large-scale deployment of MicroBT M60 miners this summer at Rockdale, we have seen significant improvements in operating uptime. In fact, one of our buildings, entirely utilizing only M60 miners, operated at over 95% uptime, even during the hottest periods of the summer, excluding only periods of power strategy-related curtailment. These new miners, to be delivered, will replace all of the older generation machines in 2 of our air-cooled buildings, which will be redeployed across other locations, thus increasing the Rockdale facility's total hash rate to 16 exahash and further improving our fleet-wide efficiency to 21.4 joules per terahash by the year end. Closing out 2024, we remain on track to fully complete the first 400 megawatt phase of our Corsicana facility by year end. All critical equipment has been deployed, and we are in the process of commissioning the final systems of this development. For 2025, we are lowering our year-end exit hash rate forecast from 56 exahash to 46.7 exahash. We are taking a more cautious approach relative to prior guidance, driven by longer lead times on substation equipment for Corsicana, as a result of which we now expect 2 buildings to come online in 2025 versus our previous expectation of 3 buildings. This change accounts for approximately 4 exahash of the lower guidance. Additionally, we are pushing out some of the expected Kentucky expansion for 2025 into 2026 and 2027. We now expect the initial phase of the Coleman Road facility to come online in 2026, with subsequent phases coming online in the following year. This change will result in approximately 8.8 exahash of 2025 growth now being pushed out into 2026 and 2027. In 2023, Riot made the strategic decision to enter a long-term purchase agreement with MicroBT, with an option to purchase an additional 75 exahash with a price ceiling of $16.40 per terahash. During 2024, we have received and deployed a majority of the miners from our initial purchase orders and have been extremely pleased with the results of both the purpose-built immersion models at Corsicana and air-cooled models at Rockdale. We have seen a significant improvement in operating uptime with these machines, and we are leveraging what we have learned to improve operations across all our facilities. With the most recent deployments, Riot's fleet efficiency now stands at 23 joules per terahash. To date, our orders for new miners from MicroBT have been received at or ahead of schedule, as we have now received approximately 90,000 miners, with the vast majority already deployed. As additional newest generation miners from MicroBT are received and deployed, Riot's total fleet efficiency is expected to improve to 20.3 joules per terahash in 2025. Riot's balance sheet strength enables us to commit to growth investments that will allow us to achieve a hash rate growth target for 2025 of 46.7 exahash. We now anticipate CapEx spending of approximately $663 million over the next 5 quarters to the end of 2025, reduced from our prior guidance of $713 million based on our latest growth forecast. It is important to note that some of our CapEx spend in 2025 will also be setting the foundation for future growth in 2026 and beyond. As an example, approximately $50 million of additional Corsicana CapEx in 2025 is for our 600 megawatt substation, which will ensure that we can provide sufficient power to future developments on site. Maintaining a strong liquidity position allows Riot to continue to make long-term decisions that will yield results well into the future. Riot's vision is to be the world's leading Bitcoin-driven infrastructure platform. In achieving this vision, we are in the process of completing a 181% increase in deployed hash rate in 2024, positioning us to mine more Bitcoin per day post-halving than we were prior. We also continue to realize one of the industry's lowest cost to mine at $35,376 per Bitcoin during the quarter. In working towards our vision, our objective is to leverage our cost advantages and efficiency over a growing scale into the coming years. Over the past few quarters, the demand for power assets by both Bitcoin miners and now AI HPC companies has grown significantly. There is a notable sense of urgency for power access in 2025, with AI HPC companies willing to pay a premium for timely access at attractive sites. Longer term, we continue to see a robust pipeline of energy assets available to us, and we remain highly active in continuing to evaluate opportunities to enhance our pipeline of power capacity well into the future. Riot will continue to monitor industry trends and make decisions that provide the greatest benefit to our shareholders, while also staying focused on our long-term goal of reaching 100 exahash in total self-mining hash rate. We are incredibly excited about what Riot is accomplishing this year, and we look forward to executing on our stated goals and reporting to you on our progress and success. Thank you all for listening to our presentation. We would now like to open the call for questions. Operator.
As a reminder, to ask a question, please press star 11 on your telephone and wait for your name to be announced.
Gotta hand it to him. He's a
Withdraw your
very
question,
energetic
please press star 11
speaker.
again. Please stand by while we compile the Q&A roster.
Stock is down. Let me add her to the stage really quick.
What was that, like
Mike
10%?
Colonnese with H.C. Wainwright.
Hey, good afternoon, guys, and congratulations on all the hash rate expansion over the past couple of quarters. Really good to see. First one for me, maybe Jason, you pointed this out a bit on the call here, but just evaluating the numbers for September, obviously there's been a pretty big delta between Riot's deployed hash rate and average operating hash rate in recent months. And I can appreciate that you're rapidly energizing new miners and actively curtailing over the summer months. But going forward, how should investors really think about Riot's utilization rate?
So, as we talked about in the prepared remarks here, we are super focused on achieving operational excellence. To us, this means large-scale operations running in a safe and compliant manner at a high uptime. Currently, we're aiming to achieve greater than 95% average utilization of deployed hash rate. And that is excluding periods of curtailment related to power strategy. Of course, as you touched on, Mike, this is not an overnight fix, but we have been very, very pleased with the rapid improvements that we've been seeing. So previously, Riot was reporting hash rate utilization in the month in the 60 to 70% range. And now for the most recent month, we're over 80%. We believe with the continued growth at continued growth at Corsicana, where we're very pleased with the new systems and how they're operating there, combined with the ongoing work at Rockdale that we touched on, where we're installing new M60 miners there, that this utilization is going to continue to improve to the end of the year, and we're going to enter 2025 very strong. So not an overnight fix, but our goal is to get to greater than 95% average utilization uptime.
That's great. That's great.
How is that going to work?
Obviously, you guys have tremendous organic growth opportunities through Corsicana over the next couple of years here. But I'm just curious, your appetite for additional M&A here. If you could just speak to what you're seeing in the market right now for deals on both the private and public side.
Sure. Let me turn that question over to Jason Chung.
Hey, Mike. Thanks for the question. Just to address that point, I think we continue to see a very robust flow of deal opportunities, both on the public and private side, but I would say in particular on the private side as it comes to private miners. I believe the challenging hash price conditions post-halving, alongside a lack of access to capital and a general need to upgrade aging fleets, appears to be driving greater capitulation among some of the private miners in particular. So we're very active in exploring all the opportunities. Given our position in the industry, we're one of the natural bidders and usually one of the first calls to see opportunities. Got a large corporate development team that's very active in exploring these. I think overall we continue to be very disciplined in how we think about when is the right time to kind of pursue additional deals beyond the one deal we announced earlier this summer.
Great. Thank you for taking my questions.
Our next question comes from the line of Darren Aftahi with Roth.
Hey guys, thanks for taking my questions. first one, I guess, Jason, your comments about improved utilization, outside of just the M60 new machines, is there anything from a logistical or best practice that you're doing that's improving utilization, or is it just exclusively the machine performance?
Yeah, Darren, there's a huge number of projects that we've had underway to improve this utilization. Of course, we're pleased with the results that we're seeing from these miners, but there's a whole host of things that we've been implementing and are continuing to implement. We're improving our electrical infrastructure. We're making tweaks to how our cooling works. We're improving our on-the-ground organization around miner repair and support. We have ramped up our analytics and software capability. We're monitoring our operations on a very detailed level now, and it's allowing us to respond to things quicker and address things quicker. You put a lot of expertise at play here in order to improve with this metric. So the new miners certainly help. That's a big part of it. But there are tens, if not 100 projects that have been underway over the course of 2024 in order to really focus on getting Riot to this state of operational excellence, getting into 2025 operating very strong.
Got it. And then I guess I'd be remiss if not asking this question, assume somebody else will. As it pertains to Corsicana and the additional 600 megawatts, I mean, as it stands today, are you still exclusively thinking that's all going to be spoken for in terms of Bitcoin mining, or do you have other aspirations to use that power portfolio? Thanks.
Yeah, so we're building 600 megawatts of additional capacity. Of course, that starts with the substation, so that's bringing in energy that can be used for multiple uses. Right now, our plans are for that to use with Bitcoin, for that to be used for Bitcoin mining. We are open to opportunities to allocate that capacity in another way that's best for shareholders, that's just better economics. So we've alluded to earlier, several weeks ago, that we've begun receiving some interest in capacity, particularly capacity that could be available in 2025. And these discussions are preliminary, but they're ongoing. So if there's a good opportunity to make a good deal for power, we are going to pursue that. But as of right now, the course is expanding Bitcoin mining hash rate.
Great. Thanks for the insight.
Our next question comes from the line of Greg Lewis with BTIG. Greg, your line may be on mute.
Maybe we'll move on to the next one, operator, and he can re-queue in.
Our next question comes from Paul Golding with Macquarie.
Thanks so much, and congrats on the hash rate growth. Just wanted to ask a couple of questions here. One housekeeping question on the substation maintenance that you called out at the beginning of the month. Is that something that was driven by the utility and is factored into your $12 million in demand response credits, or is that something that didn't factor into financials? And then
no, Paul, that was. I'm sorry to interrupt you. Please.
No worries. No, that was my follow-up's unrelated. So go ahead.
Okay, it was purely engineering. It wasn't a demand response kind of action. It was planned. It was scheduled. Our internal teams at Riot handled it.
Got it. Thanks, Jason. And then I wanted to ask, since you talked specifically about ESS Metron and the capacity of that subsidiary being utilized on that government contract, how do you think more broadly about ESS Metron utilization on third-party deals versus the vertically integrated infrastructure as you build out your capacity? Is there a marginal benefit to one or the other? How are you thinking about that holistically?
So Riot is actually a fairly small customer out of ESS Metron. As you can imagine, there's so much interest for their equipment right now, building out other types of data centers, generation applications, etc. So it is not too much of a give or take decision that they have to make. We don't impede their ability to pursue all the other jobs they have queued up there. They're really valuable, though, for us getting visibility into the supply chain, reducing our cost to build, and when we do have to make quick modifications, technology is changing, we're pivoting how we're deploying something, ESS Metron can work with us very quickly, probably a lot more flexible than they would be with third-party customers because it's all in the family together. So with that government contract now being shipped out at the end of the third quarter, this has freed up significant manufacturing capacity for this engineering division. And that's great because they can get back on track towards prior revenue and gross margin levels. In this industry, the fourth quarter is typically slower for engineering division results, but with this new capacity that's now available, we are going to begin working on higher margin contracts that we'll start seeing booked and worked on in the first quarter of 2025.
Got it. Thanks. And if I could just sneak one quick one in here at the end, anything specific to call out as a key driver of the Kentucky timeline adjustment for the, I believe it's 1.8 exahash you noted? Thanks.
Yeah. So all of the planned pipelines for growth in Kentucky remain intact. So nothing's being canceled. We're really just moving around. I touched on Riot has a portfolio of assets, and we're optimizing that portfolio based on what makes the most sense with the full landscape in front of us. The only reason that growth in Kentucky has been pushed out was so we can spend some extra time in order to maximize the power capacity that we get, while also ensuring that we're getting the best possible economics. So in this short, it's simply a matter of prioritizing quality over speed.
Got it. Thanks so much.
Thank you, Paul.
Thank you. Our next question will come from Joe Flynn from Compass Point Research and Trading. Your line is open.
Hi, guys. Thanks for the question. I was hoping you could, provide more details into the, continued increases in SG&A, which, you attributed to one-time items, but, it looks like that's spilling over into the fourth quarter. And I guess on the litigation front, like, what is the status of, litigation with the hosting counterparties as that, continues to be a gross profit drag on the business? Thanks.
Yeah, thanks, Joe. So I'll start backwards. So I can't provide any updates on the litigation. We can't really comment on it on litigation, but these cases are still ongoing. We have been, speaking to the cash G&A, we have been extremely active in M&A during 2024. And so you see in our financials, the closing of the acquisition of Block Mining resulted in $3 million of expenses being expensed under that acquisition-related cost bucket. And for M&A deals that have not closed, such as activities related to our engagement with Bitfarms, for the Bitfarms example, of course, we incurred approximately $4 million in one-time costs. And those are classified on our financials under G&A. As you noted, we're also added elevated expenses due to ongoing litigation. This is with legacy hosting customers that we inherited from the Whinstone acquisition in 2021. Now, what we think is important here is that on a run rate basis, when you remove one-time M&A and litigation-related expenses for the quarter, our cash SG&A came in at $26.5 million, which is in line with our previous guidance. And noting this includes $700,000 in cash SG&A costs and business and compensation expenses as a result of the Kentucky acquisition and folding those operations in. So yes, we do expect these litigation costs to be elevated in the fourth quarter, unfortunately, but these are temporary in nature. They're not relative to the run rate of operating our business on an ongoing level. So they're ones we unfortunately have to incur right now, and we're looking forward to having behind us when concluded.
Thanks. And to piggyback off the earlier question, it sounded like we would be open to all options regarding the 600 megawatt substation. Just curious if you've started conversations with, even if early, with potential HPC counterparties, and or if going forward and building that could 600 megawatt substation, could that lead to increased activity? Thanks.
Our belief is more power capacity is more optionality, and the explosion of demand with AI HPC only makes that optionality more valuable. So, like I noted earlier, these discussions are still preliminary, but they are ongoing. We're trying to see if there's a good deal that can be struck here to monetize this capacity. That's an improvement over Bitcoin mining. If that reaches a conclusion, then we'll certainly update the market. But we are at least encouraged by the fact that we've seen interest from multiple parties.
All right, thanks. That's all for me.
Our next question comes from Bill Papanastasiou with Stifel.
Yeah, good evening, gentlemen. Thanks for taking my questions. For the first one, I just want to touch on ESS Metron. Curious whether you're able to quantify this demanding growth in recent quarters from the AI HPC space. Can you share some color on how scalable ESS Metron is today and its ability to satisfy this growth and demand? Thanks.
I would say for these type of services, there is a lot of demand. ESS is limited by the size of that facility and the workers and the equipment, but mainly the size of the facility available for manufacturing there. And there are interested jobs that they will accept delivery times way far out just to get on the line for equipment at this point. So while there's a lot of demand for immediate growth, there are many companies planning for growth many years into the future, and they just want to get in line right now for when that capacity increases. I don't have a forecast for you of how we can increase that capacity right now. Obviously, that is something that we think about in order to fully capture this opportunity available. And unfortunately, I don't have a number for you to quantify what the demand is, but I can tell you it's a very robust demand. And the limiting factor for us is really just the size of that facility and how much equipment we can fit on that factory floor, basically. So we're looking at opportunities to increase that capacity because that would enable us to increase the revenue profile of that business.
That's great. Thank you. Helpful. And then for the second one, following the settlement agreement with Bitfarms.
Ooh, there it is.
How management is thinking today.
There's the elephant.
And
the Bitfarms takeover.
My understanding is that the settlement agreement didn't preclude you from making another attempt at going at Bitfarms. And I'm curious on your thoughts there.
Yeah, that's correct, Bill. So, first and foremost, as a large shareholder of Bitfarms, we clearly want them to succeed. We believe as a result of our engagement with Bitfarms, a number of positive corporate governance changes have been made. And today, Bitfarms is a much different company than it was at the start of this year. And we think this is a change that benefits all shareholders and will help Bitfarms to be successful. We've entered into the settlement agreement. There are no other attempts at corporate governance changes that could even possibly be made for some time. So with respect to our current position, we're going to continue to evaluate that. And we're going to determine what we believe will be the best use of our capital. We haven't made any final decisions on what our longer-term plans are here. A lot of this is really going to be driven by a number of factors, such as Bitfarms' own strategic development and execution, as well as Riot's strategic development and execution, as well as all the sector and market dynamics at play.
Thanks, Jason. Really appreciate the color there.
Our next question comes from Greg Lewis with BTIG.
Hey, good. Can you hear me? Good. Hello?
Hey, Greg. Yep, I hear you.
Okay, well, yes, definitely technical difficulties out there. Hey guys, I was hoping you could talk about clearly you're highlighting the build out of Corsicana. Just kind of curious, like, is there land and the possibility to kind of, and I guess this goes for Rockdale as well, Is there any potential possibility over the next few years to expand those sites to make them bigger in terms of power capacity if you were to go through the necessary, filings with ERCOT?
Thanks for the question, Greg. With what we've built out in Texas, I don't only mean the operational base we've built out, but the relationships we've built out, what we've learned, everything in place as a result of building these two huge sites. We feel we have a really good advantage in being able to pursue greenfield opportunities and get additional capacity in Texas, whether it's near our current sites or elsewhere in Texas. These are things we're working on a regular basis. One of the things that having this pipeline of immediate growth at a place like Corsicana affords us is the ability to work and think longer term. So we're able to have our operations team developing Corsicana up to its full 1 gigawatt. And meanwhile, we're working on all these other opportunities or projects in the background that could either come in the immediate future years, 2025, 2026, or even beyond that. So I don't have any other detail that I can update for you with right now. We're always looking to create more optionality for us and increase our power capacity. And we're doing that with both potential organic growth opportunities and M&A opportunities as well.
Okay, super helpful. And then on the delays, the Corsicana seems pretty straightforward. There's, the transformer's just going to show up later. Any kind of color around, Kentucky and it sounds like we're going to be more conservative with the guidance going forward around that. But kind of any kind of context you can give us around what maybe some of the delays that are kind of in Kentucky.
Yeah, so I'll give you two pieces of color on that, Greg. The biggest reason is that, well, first off, all the growth pipelines remain intact in Kentucky. The main reason that these growth timelines were pushed out is because there's an opportunity to spend some extra time in order to maximize the power capacity that we're getting out of these, and also helping us get the best possible economics. So we kind of made the decision of prioritizing getting the most out of these as opposed to prioritizing getting them as quickly as possible. There's also an element of that for us on the design opportunity. We found some ways that we felt we could build better operations for cheaper, actually, but some equipment would take a little bit longer of a time, ironically. So with all the capacity growth we have, we didn't feel an urgency to try and cut off opportunities or options for us by trying to make Kentucky grow as quickly as possible. We're focused on the high value growth opportunities we have elsewhere, and then we're flushing those out so those are very solid in the future years to come.
Okay, perfect. Super helpful. Thanks, Jason.
Thank you, Greg.
Our next question comes from Brett Knobloch with Cantor Fitzgerald.
Hi guys, thanks for taking my question. Maybe the first one, it seems like there's definitely quite a pickup in urgency to add or expand your power infrastructure assets. Are you guys feeling that urgency to maybe go out and find additional sites, whether it's inside or outside of Texas, in addition to the Rockdale?
My man is in a tunnel.
Hedges?
Sorry, it was very difficult to hear. Were you talking about power hedges? Did I hear you correctly?
No, just looking for additional sites outside of the ones that you guys have, maybe outside of Texas.
Oh, okay.
Increase urgency on your guys' end?
I wouldn't say there's necessarily increased urgency. It's kind of in our DNA to try and procure as many high-value power assets as possible. And this is work that goes back as far as 4 years ago. At the end of 2020, Bitcoin's 14,000, and Riot, we were felt extreme amount of urgency in being able to develop a vertically integrated platform to start layering in different power assets. So I wouldn't say there's an urgency because we are very disciplined in our process. We're not looking to bring in power assets just for the sake of capacity. We go through an incredible amount of diligence to make sure the opportunities that come across our desk are ones that we actually want to pursue and have long-term value. So, in short, the pipeline of growth that we've developed in Corsicana, Rockdale, Kentucky means we are not dependent on M&A to achieve significant hash rate growth. We have a 2 gigawatt pipeline, and we've only developed about half of that so far. So we are patiently evaluating opportunities to continue and bolster that pipeline in the future years to come.
Perfect, thank you. Maybe just one more. I know it's kind of been asked a couple of ways on the AI HPC optionality that's maybe embedded at Corsicana. Regarding the customer interest, have you guys been going out and marketing that site for that optionality, or have customers been coming to you expressing interest? Thank you.
We have not had a marketing and sales process. We have been receiving inbounds. Obviously, something we've touched on before is in these type of deals, the counterparty quality is incredibly important. So we've been having discussions with those counterparties that we believe are blue chip and have the capital and credibility to bolster a long-term agreement. And I think Riot's reputation and our image of having so much power capacity is what's resulting in us getting these unsolicited offers for really significant amounts of power capacity. The interest that we're seeing is for hundreds of megawatts, not necessarily smaller amounts.
Thanks very much. Appreciate it. That's important, guys.
Thanks, Brett.
Our next question comes from Mike Grondal with Northland Capital Markets.
Hey guys, this is Owen on for Mike. Just super quickly for me, can you provide some more color on the power curtailment strategy? And is it safe to assume the reasoning for the decline in power curtailment revenue on a year-over-year basis is mostly due to lighter demand?
Good question. So the power strategy has a few main components. One, for our power that's unhedged, we simply want to curtail when power on the spot market is above our break-even levels. And what's great about Texas, the abundance of energy there, we are really able to achieve a very good cost of power, only curtailing a few percentage of the year. In fact, we back-tested the break-even price for an M66S miner and back-tested over 2023 energy prices in Texas. And if we curtailed 3-4% of the time, we're able to get a $31 per megawatt hour all-in cost of power. Now, those 3 to 4% hours is where we're able to earn credits with our hedged power. In 2023, there was a lot of volatility in the summer months, and we were able to earn quite a bit of power credit. So even with the same volume of hedges in 2024, we did not see that same level of volatility, so we did not earn the same level of power credits. Now, that feeds into our strategy, though, because the lack of volatility meant that there were lower prices that we were able to procure at Corsicana, now using more power than Rockdale at the spot level. We're always going to be involved in trying to demonstrate the value of Bitcoin mining. That means helping provide grid stability, helping improve the financial profile of generator assets, being a large flexible load that responds to events on the grid. And that either comes in the form of saving on power costs, not paying high prices, and shutting off our load during those time periods, or being able to monetize the financial commitment that we made with the hedge during those periods as well. So we have a whole team dedicated to our power strategy that's always looking at opportunities. We believe the forward curve has been relatively elevated relative to the market prices of power that we're seeing. There was a lot of fear of volatility going into summer 2024, and that volatility did not materialize. The abundance of solar was able to fill in the gap that caused volatile prices in the future. So I know I covered a lot there. The short of it is we are always trying to figure out ways that demonstrate the benefit of Bitcoin mining and also that improves our cost of power, improves our economics.
Great. That was really helpful. Thank you.
Our next question comes from Brian Beaton with Needham.
Great. Thanks, guys. Just a couple questions from our side. So just a follow-up to some of the last couple. Just what would you guys need to see to get into HPC? Is it simply a kind of Bitcoin cycle dynamic, or the right customer coming around? If you could kind of pick between the two. And then separately, just on the timeline delays, for the electrical equipment delays, what's the latest on timelines for getting some of those long lead time items going?
So your first question, what will we need to see to get into AI HPC? One of the components you nailed is a strong blue chip counterparty. This would be a significant amount of development, repurpose of assets going down a direction it's not very easy to U-turn from. So we really want to be sure we're working with a very strong, well-capitalized counterparty. We're not really trying to time the cyclicality of the Bitcoin mining market. We're really looking at, are these economics that are going to be better for us than Bitcoin mining? And where that's particularly relevant is on the upfront CapEx side. Building AI HPC data centers is incredibly more expensive than building Bitcoin mining facilities. So I think we'd be looking to pursue one of these type of deals if it's improving our capital efficiency, not making it more challenging. So I think that's the easy answer to your question. Depends on the counterparty, and it depends on the type of deal that's put in front of us. And remind me your second question.
Yeah, just on the that's helpful.
The long lead items.
The long lead items, exactly.
Yeah. So while we have just recently initiated this phase 2 development, we have ordered those long lead items in the past. When you're talking about a 345 kV, 138 kV substation, these things are 18 plus months in lead time. They can be even 24 months. So it is quite a long lead line for these items. So thankfully, we already have these orders in, and that's why we expect to receive them in a little under a year, as opposed to the 18 or 24 months that a new order might be looking at right now.
Great. Thanks, guys.
Our next question comes from Lucas Pipes with B. Riley.
Thank you very much, operator. Good afternoon, everyone. Jason, you mentioned a few times that you've been active looking at M&A, and I wonder, where does this focus rank today? And kind of bigger picture, what sort of M&A opportunities are you looking at? Are you elephant hunting? Are you looking at smaller bolt-ons? Would be great to have a little bit better feel for that. Thank you very much.
Thanks, Lucas. So I would not say it is a choice of one or the other for us. We made the decision long ago in the company to invest in building out the corporate development team. So while one part of the company is focused on building out operations and the organic pipeline in front of us, we have a completely separate team of talented individuals that are looking at M&A opportunities. So by building out this corporate infrastructure, we're able to do both of these things at once, which we think is very important because of the scale and the sense of urgency in this whole space. With respect to the types of M&A opportunities that we're looking at, let me turn that question over to Jason Chung, our EVP and Head of Corporate Development and Strategy.
Thanks, Jason. Hey, Lucas. A couple of comments to that question. First, when it comes to the type of opportunity and whether we're whale hunting or not, I would say we're relatively open to many different types of transactions. There does need to be a certain level of scale for it to really move the needle for us. And so we're open to larger deals, but sometimes we see interesting opportunities or interesting valuations on the smaller end of the scale, which over time can eventually grow into something that's much more meaningful. So I don't think we think of it as whale hunting versus, and ignoring some of the smaller opportunities. It's really the right fine combination of valuation, operational excellence, and operating in a jurisdiction that we want to be in. I think the last comment I'll have to that question, to your question, Lucas, is although we did recently complete a transaction this past summer The only thing that precludes us from closing another deal is finding the right opportunity. So we're very open to M&A. We're actively exploring opportunities to help supplement our large organic growth pipeline.
Thank you, Jason. And a quick follow-up on this theme. First, do you find yourself competing with hyperscalers, AI, HPC leaning organizations, or not? And secondly, when you screen for acquisitions, does AI, HPC factor in, or are you really more focused on the BTC side? Thank you.
I'll take that, Lucas. So there is a competition with AI HPC companies on some assets, but our advantage is the universe of assets that work for Bitcoin mining is much larger than that of assets that work for AI HPC. So really talking about the location and quality of different sites. In some areas may be very, very remote and very difficult to build. Maybe it takes more time to build AI HPC, where Bitcoin mining can work a lot quicker. There are cases where people are building Bitcoin mining facilities in very remote locations and using just cell phone internet in order to add internet to those. Obviously, that's not going to work for an AI HPC data center. So the fact that this universe of assets that work for Bitcoin, of assets that work for AI HPC companies, we have an advantage over them in securing additional power capacity. I would not say we're necessarily looking at AI HPC companies specifically, but when we're looking at power assets, we are thinking about the optionality that gives us, and if they are potentially assets that we could strike a good deal with an AI operator. The key point is we're trying to get access to power.
Jason, thanks again for the color, and all the best of luck.
Thank you, Lucas.
Our next question comes from the line of Reggie Smith with JP Morgan.
Hey guys, thanks for taking the question. Most of mine have been hit. I was just curious. Just one of your larger competitors recently, made comments about kind of pausing greenfield development and using proceeds to buy Bitcoin directly, and it kind of cited hash price and things like that. Obviously, that company has a different asset base and land base than you guys. But I was just curious how you think about the decision to buy Bitcoin to build sites and things like that within the context of hash price, and whether that kind of weighs into your capital allocation decisions.
Yeah, thanks, Reggie. So, first and foremost, as part of this vertically integrated strategy, we prioritize building a portfolio and a pipeline of assets that we can act on, and how and when we monetize those is really up to our discretion. Of course, over recent years, the priority and the opportunity has been to build out those assets for Bitcoin mining. We think by what we've demonstrated as a low-cost producer, that with one of the industry's lowest cost of power, 3.1 cents per kilowatt hour for the third quarter of 2024 here, that our best method of accumulating Bitcoin is to leverage that power efficiency over a wide scale and effectively being able to procure Bitcoin at a discount to the market price. Our cost to mine for the quarter, including our power and on-the-ground operations expenses, was $35,376 per Bitcoin. That's considerably less than what the market price of Bitcoin was during the period. So we think by being a low-cost producer with this industry-leading power strategy, that is the best way for us to get exposure to Bitcoin. Of course, we're a Bitcoin company, so anyone buying Bitcoin, any institution, is exciting to us. Everyone has a different take of how they prioritize their capital. We're using the low cost of power and putting that to work, showing the benefits of Bitcoin mining.
If I can ask a quick follow-up on that, I totally appreciate the low cost of mining one of the things that we've been kind of talking about is not just the cost to mine, but the kind of time it takes to mine the amount of coins. Can you talk a little bit about maybe how that or how you consider or think about the time? Because presumably you could buy Bitcoin today or you could mine Bitcoin, and there's some time differential there. How does that play into your calculus, if at all?
Well, I think what Bitcoin mining affords is really a mechanism for averaging into Bitcoin over a period of time. If the price of Bitcoin went down, presumably in most cases, when it goes down for a prolonged period of time, network difficulty responds as the higher cost producers fall off, and then you're mining Bitcoin at a lower price. This is a dynamic we saw if you compare 2021 to going into the bear market 2022 and 2023 when cost of mine fluctuated around changes in network difficulty. So I think with Bitcoin mining, what you're doing is you're positioning yourself to average in over time instead of picking one price and saying, okay, instead of the CapEx that I would load out into building out a facility or new operation, I'm going to load into Bitcoin at this price. And you're instead kind of smoothing out and de-risking what that exposure would be. It also allows us to be there when the Bitcoin price appreciates, when the economics in Bitcoin mining suddenly and unpredictably explode, and then we're there already with an in-place operation, no lag in deploying new hash rate in order to capture that opportunity. So I think the short answer to your question, Reggie, is it kind of comes down to your time. Do you want to average in over time, or do you want to take a swing right now? We think with our cost efficiencies, it makes the most sense and is, perhaps less risky to average in over time.
No, that actually makes a lot of sense. If I could sneak one more in, and I know you guys have talked about HPC ad nauseum tonight, but I was curious. I look at your two sites and them being located so close to Dallas and Austin. I was just curious whether or not that has come up as like an asset or a key feature of your sites in discussing, obviously the scale of them as well, but like in discussing HPC with potential partners or not. Just curious, because it seems like you guys have a really good location, but maybe I'm overestimating that. So I don't know if you've heard that echoed as well in your discussions. Thanks.
Yeah, that is a good question, Reggie. Those locations near the major metropolitans is an advantage. First off, for getting people. It takes an army of people to operate these large sites, whether it's Bitcoin mining or if it's AI HPC data centers. So you want high quality people there. And if you're near a bigger cities like Dallas or Austin, they're more nearby. Particularly you look at a Rockdale facility, there's a tremendous amount of development in that area, particularly with the Samsung foundry that has been built there. There's a lot more talent that's coming in around there. Also, as a result of being near these large metropolitans, there's multiple fiber internet options. So that makes that's an attractive quality to potential AI HPC data centers as well. We've also, near some of those locations, there already exist large tech companies, and that just is furthermore value to the potential counterparties that would want to build around there. So major metropolitans have been seem to be an attractive quality.
Got it. Figured as much. Okay, thank you.
That concludes today's question and answer session. I'd like to turn the call back to Phil McPherson for closing remarks.
Thank you, operator. We'd like to thank everybody for joining Riot Platforms on their third quarter 24 earnings call. We look forward to updating you on future developments, and we're always available for your questions. We'll see you early next year for the year end. Thank you.
This concludes today's conference call. Thank you for participating. You may now disconnect.
Okay.
Pleasure. Hey, Penny, check your Twitter DMs.
Let me pull up the trading view.
Okay, so a lot to unpack from that. And if y'all have anything that you want us to talk specifically Obviously, we got Penny in the chat. Great resource. He's slinging numbers around. I wouldn't mind getting him up here on the stage. Penny, if that is interesting to you, let us know. Just dropped you a StreamYard link into Twitter DMs. So if you want to come and share your insights, double check, dude. I just sent it. Maybe from my account specifically, Colin as I lay hodling. Unless I'm following an imposter Penny, which would not be good. Sweet. Yeah, hop on, man. We'll get you on here. Lot to unpack from that, though. As a couple of people pointed out in the chat, a few highlights. They've revised their end of year exahash target from 36.3 exahashes to 34.9. I believe part of that was due to some complications with the new facilities in Kentucky. Jason answered a question about that from one of the analysts. Penny, welcome to the stage, man.
Welcome,
Hey, how's it
Penny.
going? I have to admit, I wasn't paying attention to a lot of the words in the thing. I was doing all these numbers.
Yeah, it's hard, right? I was doing
It
the
is.
same thing on the end. I was like just trying to like get numbers in front of my screen so that we could have something to talk about.
Yeah. It's
Some
all
of the
in
analyst
the bottom
questions.
of the presentation is where all the good stuff is.
Yeah, 100%. I want to just go through what I consider to be a few highlights, Penny, and then we'll kind of just chop it up, take it wherever you want to go. So yeah, exahash target being revised, average hash rate versus average end of the month hash rate or nameplate hash rate, which can be deceiving considering like they deploy hash rate throughout the month, but their hash rate did not grow that much from the end of Q2 to the end of Q3, but their average hash rate was 16.5 exahashes over Q3. Not really the uptime we want to see. It's in like the 60% range. And something that you pointed out, Penny, the margins Q3, their cost of revenue was not as high as we might expect it to be given how much hash rate they had deployed. And it was the margins for Q3 for self-mining were 42% versus 36.74% for Q2. So a little bit of an improvement there.
Yeah, I'm not sure what their count. Are you going off the numbers they use there for the margin?
Yes, yeah. So I think that part of that might be the fact that they had a slight bump, a slight improvement to their efficiency, right? It went from like 25.4 joules per terahash. Let me make sure I'm not butchering that. Yeah, 24.5 joules per terahash at the end of Q2 to 23 joules per terahash at the end of Q3. That's
By the way,
not
where'd you
that
get
good.
where'd you get those from? Because I've been looking for their.
Okay, so the 23 is in their most recent presentation. I'm pretty sure that this is my one of my spreadsheets backdated from the last time I pulled data for Q2. I think the 24.5 is either from an older presentation or from a press release.
Oh, okay.
Yeah.
Yeah, I wish they would just do it in the monthly updates, like most
it'd
other
be
miners.
nice, right?
Yeah.
They're weird. They're like transparent about uptime, I guess, because of their curtailment credits. But then there are other things that they don't leave out that other miners include, like the joules per terahash.
In the last interview that Anthony did with him, he asked him about that, and he was like, "Well, every time I talk to you, you want to add a new thing in that. Maybe we'll get around to it."
I mean, as you know, as one of the premier analysts, it's super great when you can get all that stuff in the monthly updates, right? And
Yeah,
this is
I'm surprised it's not like demanded by investors. Like it's one of the probably top 3 things you want to know about a miner you're invested in is like what the efficiency of their fleet is. It's as important as their cost of power.
100%. And on that note, kind of a bone that I wanted to pick with the expectations for revenue. So I was looking at, I was just curious as to where people were getting some of these expectations. There's this company called Zacks that does stock analysis, and their estimates for Q3 for Riot were 93 million.
Okay.
Which is funny, but you know what it's based on?
ridiculous.
I realized, I was like, where are you getting that? So I looked at the average hash price for Q3. It's $45 per petahash per day. And if we look at their end of year or end of quarter hash rate for Q2, which was 22 exahashes a second, that's where they're getting that.
They're just assuming 100% uptime?
Yeah, 100%.
So there's alpha in looking at the monthly updates, like the big number on a monthly update.
100%, right? I mean, that's like
Yeah.
what apparently that's the standard still. I mean, it goes back to just the fact that the investor sphere for all these mining stocks is still so immature. Because if we actually look at the monthly updates and they give us the average hash rate for each month, if
But
we
they give
take
you their
that,
revenue. Like,
yeah,
you can just they
exactly.
tell you
And
how many
so
Bitcoin they mined, and you know what the average price was for the month. So
yeah. So if we take average hash price and the average, and if we take average hash price for the month and we take average hash rate, we get 66.8 million for revenue. So if we're using that as a barometer, which I think is more realistic expectations, they basically nailed that, right? They got
of course, yeah.
67.5.
I mean, what I do is I take each monthly update, I look at how many Bitcoin they mined, and I multiply it by the average price of Bitcoin for that period. Since you don't know how much they mined in the front end or the back end of the period, you just average it. And then
Yep.
I just add that up for the 3 months. I got 67.3. And
Yep.
the mining
Perfect.
revenue is 67.5. So it's like a error of what? Like less than 1%.
Right.
The wild card here is like you don't know what's going to happen with engineering or other. And other
Yeah.
is now what data center hosting used to be, I think. So in Q1, they combined those together and it was just Bitcoin mining and engineering. And other was like these license fees of like $24,000 a quarter or something. It's like nothing. And then in Q2, they broke out Bitcoin mining. They put the data center stuff into other. So that makes their mining stuff look better. But anyway, long story short, like I don't know how anyone could guess that their engineering revenue would go from 8 million to 12 point, or it's from
No.
9.6 to 12.6. But I kind of just ignore it because that's a pretty like they're not making or losing a ton of money on that. So I don't care what it is. So
Yeah, and I don't think investors should. I mean, to me, that's a
well,
vertical
definitely not.
integration play, right? Like
Yeah.
there's really no benefit other than making sure that they can source and repair source parts, repair things at a cheaper cost otherwise than outsourcing it to another company. But what are some of your other takeaways from this, Penny? I mean, did Riot and your estimation come out on top from this earnings call? Or are they kind of just or did they underperform compared to what you were expecting going into the call?
They performed more or less pretty close to what I expected. So I put a tweet out before and I updated that while the earnings was there. So, you know, I missed my estimation of net income, but that's just due to a bunch of non-cash things where you have no idea how to guess what they are. Like depreciation came in higher and the value of their power thing, of their derivative asset went down a lot. Like I'm not going to go look at the future power curve prices and try to back out the value of their PPA just to get net income right. But what I look at is just the basic mining profitability. So I look at their revenue from mining, I look at their cost of revenue for mining, and Riot is nice because they break it out. In the filing, they'll break out like the direct power costs and also the indirect costs, which is a bunch of other things like compensation, insurance on miners,
Payroll,
ground.
things like that.
Yeah. But somehow it's the payroll specifically for cost of revenue of mining, not like payroll for other things that goes in SG&A. So yeah, let me start over and just keep it simple. I look at revenue. I look at cost of revenue for mining, cash SG&A. So you take the regular SG&A and subtract out the stock-based comp, and then I look at power credits because they should get credit for turning off some miners to get money, in theory. So yeah, I look at that, and I thought they were gonna burn about 7.3 million, and they burned 7.9. So that's pretty much what I expected. There's really no surprises there. The only thing I was surprised in is their mining cost of revenue was less than I thought. So maybe
Right.
I overestimated or I underestimated their fleet efficiency. Like I had them at like 27 joules or 28 joules per terahash, which means I was thinking they would use more kilowatt hours and it would cost them more. Or, maybe they actually had a lower cost of power for the quarter. I don't know how their hedging or PPA works, all that.
Right.
But on the flip side, so they came in under for what I guessed there, but they came in over for what I was hoping for cash SG&A. So I was hoping they would keep it, kind of flat at 32 million. Flat at in Q2 they were 29 million. I thought it might tick up to maybe 32, but it went all the way from 29 to 36.4. So that jumped up a bunch, but it moved up less on a percentage basis than their like hash rate or any other metric. So, there is an economy of scale there. So that's good. I think they've been punished a lot because that cost was just continually growing and their hash rate wasn't.
Right, and they've had historically one of the highest SG&As of some of the bigger
And
miners.
it is still, I
Still
think
very high. I mean,
I
if you
think it
look at,
still might be the highest on a hash yeah, it's the highest.
yeah, and,
So
and then if you adjust for stock-based compensation, it's like, what was it, like 66 million for the quarter?
yeah, you just don't wanna look at that.
Just a little more dilution. Going back to the cost of revenue thing, and sorry, Charlie, not trying to box you out. I see your
I'm just here for emotional support because I don't look as closely at the
Charlie is a
financials anymore.
emotional support human.
Oh, that's great.
Going back to the cost of revenue, I do think the efficiency thing plays in obviously here. Maybe we're seeing the benefits of the immersion rollout at Corsicana. That entire the first phase, and I believe the whole facility, correct me if I'm wrong, Penny, is geared towards immersion. But the other thing,
Yeah, call it Immersicana.
Immersicana, that's nice. I like that. But going back to what you were saying earlier, though, too, we don't know how they're applying curtailment credits either, right? So they might have rolled older curtailment credits into this quarter. We don't really know how those are structured. That could help. With regards to curtailment, though, a much lighter quarter than last year, where they earned, so they got like 12.4 million in curtailment credits this year, or sorry, for Q3 this year. Last year, it was in the ballpark of
like 50 something.
50 million, yeah, 49.6 million last year.
But a big chunk of that was for went towards the hosting segment, but it was still really big for the mining segment.
Right. And then last quarter they had 13.9 million. So this is the thing that I'm curious about. Jason talked a lot about uptime, Riot, and you can see this when you run certain numbers for them, right? It really impacts some of these ratios that we look at when you kind of break these things out. I was doing the Q2 numbers a while ago for block space, and if you when you look at like hash cost at the end of the day, when you look at revenue per megawatt, they had the lowest revenue per megawatt of any of the miners that we analyzed. It really impacts them down the road. Jason spent a good amount of time, and a lot of analysts asked about their uptime. He said they want to get to 95%. And I'm curious about your thoughts on that, because I don't see how that's possible in certain quarters and months with their curtailment strategy. But maybe I'm overestimating how much they actually curtail.
Oh, absolutely. So curtailment is only when the cost of power is above what they make from mining. And so that'll generally be probably what they make from mining is like, what do you think, like 9 cents or 10 cents? If you just look at the cost of electricity versus
You're saying per
kilowatt hour, yeah.
Yeah.
It's like for like an S21, I think it's like 11 cents or 10 cents, something like that. So only when the power price goes above that would they want to curtail, and that's probably only, less than 5% of the month. In some of their presentations, they show you what percent uptime they can have if they only curtail at a certain point, or if they buy I forget where it is. You should find that slide. It's a really cool slide. It's could find it later. But basically if you go by the amount of time they would have to curtail, it's only during those like super peaks, and I don't think that's going to be that much on a quarterly basis. I would guess like 5% or something. But they have their own estimate, which is what they were saying. Like at Corsicana, we don't have to buy PPA because our hedging strategy is like this, and it's going to do 95% uptime. So I think there's more still. I was expecting them to have finished the whole Rockdale thing, the whole replacement of all the miners, so that they have everything running there, but they still seem a little slow on that.
So that raises the question, and I'm glad that you gave that color about the curtailment, because that was kind of, when I was thinking it through on the stream, I was like, well, it actually shouldn't be that much. So 95 should be feasible. But then that raises the question, what the hell has been going on? Because their uptime has been dismal.
So it depends how you're measuring their uptime. Let me pull that.
So I think I agree with that.
If you look at so what I do is look at the previous month's exahash deployed, that they call it, and then I expect them to hit that in the next month. So if they ended the month at whatever, the next month it should be like at least 95% of that, right?
Right.
So I think they were lagging on that. And then Rockdale has been a persistent problem for a long time. And they said they'd upgrade they bought all these micro BT miners, and they were going to have them swapped out by, I forget what the target was. I thought it was like the end of July or the end of August. So I was expecting to see that whole thing fixed. So I don't know what's going on with Rockdale, why they're not at a higher rate there. And curtailment explains it in theory, in terms of, well, they made more money in curtailment than they did from mining with the missing hash rate, but it's not really feasible unless power prices were high for I don't know. It
Right.
just doesn't seem possible because
Right.
there wouldn't be that much time that they were curtailing.
Yeah, and I
So
mean, and Jason himself said it was like 6, or maybe it was Jason, or maybe it was one of the other employees, but he said that over the past year, it's been like 60 to 70% uptime. October they hit 80%, and even that 80%.
yeah, and they said that was excluding the curtailment. So
Right.
yeah, 80%'s rough.
It is rough, especially when you got other miners. Like, I mean, CleanSpark has pretty great uptime. There are other miners who, we can almost audit Marapool, for instance, in real time to kind of get their uptime as well.
Yeah, sure. I
And
think most miners sort of report based on the amount of Bitcoin. I don't know how it works, but like,
yeah, I'd be
I don't
curious.
really I don't really follow uptime that much. I look at what they have installed at the end of the month and then what they produce the next month. But even then, they could have higher than 100% uptime
Right.
because they could have installed more hash rate in that month. So there's really like a gray area where what do you consider the hash rate they should be getting? Like, is it the moment they receive the ASIC? Is it when they plug it in? Is it when they do whatever? And they have leeway in how they want to define that or what they want to count. So I would say it's pretty easy to just say you have 100% uptime because you look at how many Bitcoin you mined and then you say that's my average
Right.
operational hash rate, and they should pretty much match up.
100%. Shifting gears really quickly to dilution. Obviously, every Bitcoin mining stock investor's Achilles heel, the thing that keeps them up at night, and the thing that always is populating our troll box, complaints of such things. I understand. I don't own any of these stocks myself, but I could see not liking that. So 730.8 million from their at the market offering so far for the 9 months ended in September. This basically taps out the 750 million ATM that they opened.
So I think I'm wrong about I think that's wrong because if you read closely, that's the year to date, but I think they renewed the ATM some point during this year, right? So it would be reset to 0 then.
Oh, really? Okay,
Yeah,
so
yeah.
they
But
still have room there.
I think so. I mean, I have to go through and do all that because there is decent alpha there because you can see which companies are close to running out of their ATM. And if you want to look at like how much it costs them to do a full hodl strategy, how much they're burning, you can sort of
Right.
like back out roughly when they would have to like refresh it.
So maybe they reloaded it. I'll fact check that here when I get your answer to this next question. But so 730 million though, but 731 call it this year from that 70 million shares, 70.1 million issued. Worth it? Not worth it? I mean, what do you think based on how much growth we've seen from them so far this year? And also, if we consider that some of that or their cash chest went to buying nearly $200 million worth of Bitfarm shares, that we don't really know what's going to happen with
Yep.
those shares at this point,
Well,
right?
it's kind of like a hedge on what Riot's going to do, right?
The Bitfarm share, the Bitfarm
Yeah, sure.
purchase?
Yeah.
Yeah. So I kind of asked two things there, but let's put Bitfarms to the side for a second. But I do think that's kind of in this conversation with how they're using their cash. But what do you think about the ATM so far? What do you think about the dilution?
I think it's a very complicated question, but from the perspective of a exec, like if I were managing the company, it's pretty easy to justify doing it. But the reason it's easy to justify doing it is because you're sort of signaling your stock might be overvalued relative to the amount of cash you're going to get. Another way to put it is if I can sell $1 million of shares and buy ASICs with that, it's going to increase my cash flow by some amount. So it's accretive. Or, it's kind of like saying my shares are priced so highly that it's worth it for me to sell them because when I buy the ASICs, my valuation might go up even more. So that's like a net. It's a decent bet. I'm not saying like Riot's super overvalued or undervalued, but I'm just saying like, from that perspective, it makes sense. From the perspective of if you look at their historical share price, like I don't know, you might want to have a little more faith in your own company that your current expansion, all the expansion that you funded and the results you're going to see in the next few months might lift up the share price and give you a better opportunity to sell the shares at a higher price. But it's hugely complicated. I don't know what they're planning on doing. Like there's all these things going on internally. And another perspective is just sure if the market's willing to buy the shares, then sell them, and you have the cash. And if you think you can deploy it, accretively, then go for it.
Right.
I think all the mining companies just want to get as big as possible. And so
100%.
if you can just dump the shares and then convert that cash into assets or into book value, you sort of set like a floor of your like multiple of your like whatever multiple you want to choose.
Right. And this is really the only financing option a lot of these guys have at this point. I mean, they don't really have the ability to access debt. I mean, in some cases they do. Sometimes that involves collateralizing their Bitcoin, though.
Right.
And maybe some investors would prefer that, but it definitely doesn't give you the same purchasing power. I mean, you just can't raise as much that way. Quick thing to revert back to the ATM. They did roll it over in August. They reopened it, or I don't know what, I don't know the actual financial maneuvering, but they have a fresh $750 million ATM on the table since August. So
Okay.
if y'all didn't like the dilution that you've seen so far this year, get ready, because it could be basically doubled at this point. So
What I wish some miners would do is, a lot of them announce fully funded for things or whatever, but I think a miner could gain a lot of like retail attraction or just positive sentiment if they said outright, we're seeking to not tap our ATM for the next, few months until we think our shares have our share price reflects the value that we think we're worth. But they always just say fully funded. And
yeah,
I don't know if there's a legal reason for that. Like if you say you're targeting to do something and then you don't do it, if that's a thing, or if they really just do intend to keep tapping the ATM.
I mean, I think you're right on the money, Penny, here, because while I granted don't pay as close attention to the actual financials, I do feel quite dialed into consumer and retail sentiment right now. And in my side chats with the everyman here, they're all crying about being diluted over the past year. I mean, understandably, nobody likes being diluted. So that would be that's like a very compelling signal to make.
It would be
guess
cool.
it's like, go ahead, Penny.
No, I'm done.
I just think that, and maybe this is because I've been swimming in the pool for so long that the pee doesn't bother me, but you just should expect this. You go to a public pool, Johnny Two Trunks over there is going to piss in the pool.
Yeah.
You invest in public miners who are basically barred from debt markets, you're gonna get dilution. Maybe you want them to sell their Bitcoin, but then some people don't want to do that because they like the idea of like Riot having 1,000 Bitcoin on its balance sheet. But at this point, and again, I should maybe caveat this by saying I'm saying this from the perspective of someone who has analyzed and researched these equities for a few years now, but this is just par for the course, and especially when stocks are ripping, they're going to do this, and I don't think there's any way around it.
I mean, so I agree it is par for the course, but certain other things are par for the course that aren't necessarily great. I'm sure you can think of the elephant in the room, which is stock-based compensation for all these miners.
Right.
And I don't know. It's just, yeah, it's normal. I think retail ultimately, a lot of people view buying the miners as just buying a lottery ticket for if Bitcoin goes up, these stocks will go up a ton. And so whatever it takes to keep that dream alive, whatever, I don't care. Everyone else is doing it, whatever. And that's not something I buy into, but I am aware that the share prices can move based on that. So, it's sort of a dual-edged sword where
Right.
I wouldn't want to own them for long-term investing, especially pure play. But sometimes I want exposure to like sentiment and a possible rally in Bitcoin.
Yeah. Sometimes you want to degen on Bitcoin mining stocks, and that's
Sometimes.
what we're here for. You
And
said
you have to pay. It's just a degen tax. The
It's
stock-based
socially
compensation.
acceptable shitcoining. It's what happens.
I mean, it's not much different from a shitcoin. They're just making more tokens and dumping them on you, right?
Yeah, the dev rugs you. Now you're talking my language. Now I can finally contribute. No.
You mentioned you would not want to hold pure play miners for long term. I know what you're referring to here, but I want to table that because I think we'll close on that topic. But I want to return to Bitfarms for a second. So for any viewers who are unaware, Riot over the past year, starting I believe in March, has been purchasing or had been purchasing Bitfarms shares to the tune of eventually like 19% of all outstanding Bitfarms stock. They ended up spending something like $200 million on these share purchases. You can actually see it that those are the equities that they, or the securities that they list as part of their cash and cash equivalents. And basically this was, I mean, Riot would take qualm with this language. In fact, Jason did on a call with me after I wrote about this for Blockspace, for the Mining Pod newsletter. He said this was not a hostile takeover, but it essentially amounts to a company trying to exert pressure on the board of another company for its favor. And all that being said, Riot and Bitfarms eventually reached a settlement that involved cycling out one of Bitfarms' board members, adding another seat, and then appointing someone for Bitfarm, or appointing a board member that Riot had proposed for the Bitfarms board. All that said, Riot is now sitting with about 19% of Bitfarms stock, $200 million worth. And if I were a Riot shareholder, I would kind of be raising my hands like this and saying, what's the point of this? I mean, what are your thoughts on this, Penny? It seems to me to be kind of an aborted takeover attempt. I don't really know what this means for Riot going forward, considering they have this treasure trove of Bitfarm shares and not really anything to show for it.
Yeah, I don't know. I don't have much to comment on it. It sort of feels like beyond my depth of understanding. I sort of, a conspiracy theory would be, oh, Riot maybe thinks they're not going to deliver as much, so they want to buy another company to fold that hash rate in and just sort of like sweep whatever's under the rug and say, look, our hash rate grew this much, and now our uptime is higher when you consolidate everything and all that. Which is the same thing as saying they want to buy a well-operated company. So there's really nothing wrong with that. It's just like, what are the motives? And I would have hoped, I don't know. It feels like with their own share price going down, if you look at the two share prices and how they're related, it seems like they'd want to do it when their share price is high and Bitfarms is lower, but they just kept running at it. So I don't know. I don't have a strong take on this either way.
I don't. I kind of have a strong take. It seems reckless to me. It seems like one of those. I mean, it just seems, and this is what it is. It seems like a huge bet where if it pays off, they look like geniuses. And if it doesn't pay off, then maybe you have a bunch of shareholders asking questions, right?
So
that being said,
in what scenario does it pay off?
Yeah, that's what I don't. That's going back to what you were saying. I'm not sure.
But at the same time, I don't know what scenario it doesn't pay off.
Yeah, and so going back to what you said, maybe there's some like 5D chess here that's being played that I just is beyond my depth of understanding of corporate finance and corporate governance. So there might be something I do want to caveat what I'm saying here. Maybe there's something in the cards that Riot has that we don't see. They have an ace somewhere. I'm mixing my metaphors, chess and poker, but you get what I'm saying. And so maybe it does pay off in the future. He did say on the call that there are still options for them to pursue this kind of takeover policy down the road, to be more aggressive. I don't know what that looks like, but it really does seem like they basically made an offer. It was like, I think for 960 million for Bitfarms at the beginning of this year. They were rebuffed, and then they just started purchasing shares and YOLOing into Bitfarms. And I'm not really sure where this goes, but I don't really see it as accretive for their shareholders nor for their business down the road. But that's kind of neither here nor there with the next topic, which is everyone's favorite elephant in the room, HPC and AI. I believe that we had, if I missed the introduction, but I believe I recognize his voice, Reggie Smith of JP Morgan on the call, basically making the claim that Rockdale and Corsicana seem to be prime targets for acquisition or retrofitting for HPC. And there are a few considerations here. Obviously, a huge megawatt footprint, all the electrical capacity and all the electrical infrastructure already in place, close to Austin, close to major city centers, a few things lining up that you need if you're going to end up retrofitting one of these things or selling it to a big hyperscaler. What do you think of those prospects, Penny? Do you think Riot's ever going to touch that? They seemed kind of cagey on the call. Do you think that this is a good opportunity for something like that? Or do you think that they're just going to keep pure playing?
I thought, it seems like all the signals they've been saying are they're going to keep pure playing, right?
Yep.
Like I said this on a tweet to someone, I think, but I remember the most hype they got about HPC was from an interviewer asking them, basically, if a CoreWeave came along and dumped a pile of cash in your lap, would you take it? And Jason was like, yeah, actually, if we got a deal like that, we'd consider it and da. And then I saw it like reposted all over the place, and I'm like, what? Like what? Of
Right.
course you take money, like free money, but I don't think it's something. And they have said that they're getting some inbound interest apparently, but I don't know. I don't know how to assess all the different sites and like what hyperscalers and everyone else is looking for, and
Right.
like, but I would probably take caution in going with a company that's had pretty terrible uptime with their own miners.
Mm.
I don't know if it's like a problem at the facility or if it's strictly with the ASICs or something else, but it might make me want to do more due diligence. And I don't know how strong the demand is. Like if you're going out and you're buying all the infrastructure and megawatts to put your HPC, I don't know where Riot's sites are on the chain of like low hanging fruit of like what meets what you can get. So I just don't know that market well enough.
Yeah, it's something that I've been increasingly researching, and it's such a freaking labyrinth
Right.
of information and honestly, like entirely new business concepts. It's very akin to Bitcoin mining in the fact that it's so nascent. I mean, not the data center industry, but specifically this new breed with AI. And just to steel man, I guess, why Riot would be good based on some of the research that Reggie Smith and Charles Purse have done for JP Morgan. Is this idea that you're gonna eventually hit a sort of ceiling of power capacity in the U.S. I mean, there's a really scary chart if you go to the EIA and you look at total terawatt hours produced per year in the US, it basically plateaus starting in the 2000s because we stopped building nuclear, we stopped building coal plants, we started shifting a lot of resources and government incentives towards renewables, and those just aren't really fitting the bill for residential consumers, let alone mass industrial scale consumers like Bitcoin miners and HPC operators. And the idea, I think, is basically these Bitcoin miners. I mean, it's a simple thesis. These Bitcoin miners have the PPAs, they've got the infrastructure. If you can actually just find a recipe that works for retrofitting those things, then eventually hyperscalers are going to come and gobble them up.
Sure, provided
Right, and on surface, it makes sense. I don't know if it actually works that way in practice, but the one thing that they do say in that report is that like the average cost to retrofit, according to some conversations that they've had, could be $5 to $7 million per megawatt for a Bitcoin mine to an HPC data center versus $12 to $20 million for just greenfielding one per megawatt. So if that's true, that's big. But again, the biggest question mark is, can you actually even do this at scale in a way that makes sense? And I think Core Scientific is the guinea pig here, obviously.
I think another open question is how quickly can you do it? Like,
Yeah.
can you get all the things in order without the huge lead times? Because the longer you wait, the more risk there is that the customer, the hyperscaler or whomever, they might not be seeing the same margins in the future. You don't know what the margins will look like 5 years from now. So if they invest a huge amount and it's not going to be ready for 3 years or 2 years, and then there's a lot of risks there. There's, let's say, LLMs don't, or it's just AI in general doesn't produce that much value and sort of the demand for it dries up. Or maybe you get there's a new algorithm discovered that means you can do the same amount of computation with, half the amount of GPUs. So suddenly you don't need, it cuts down the amount of supply you need. Or the GPUs themselves get better at a faster rate than expected. So with a future GPU, maybe you can do 100 times as much computation than you can now. So now you don't need as many GPUs. So you don't need as many megawatts. So, I don't know. They have to place a bet on what they think their future margins are going to be and what their ROI is going to be if they buy a site and wait all that time to retrofit it and then plug in their GPUs, then start making money. So I think there is the whole time premium. I think there is something big to that.
Yeah, 100%. And I think Jason basically said it right when he was asked about this strategy, if they would do it. It's a huge change. It's like a Bitcoin mine exchange. It's like you can't really go back from that. Once if you're gonna retrofit to HPC and AI, that is what you were doing, and that is your business model now. And he's basically said in the call, it's going to take a blue chip company in really favorable terms. And that's another thing that the JP Morgan report points out. This whole CoreWeave thing, where they are bankrolling the change for Corsair, is probably a one-off. I mean, that's a pretty incredible deal for Core Scientific, and I don't think we're going to see anything like that in the market after after this thing with Core Sci and CoreWeave. Got a question from Cowboy Habibi. Great name. How much risk is there in hyperscalers buying them out during the bear? They can't be dumb enough to buy at the top, can they? Oh man.
The bear of what? I mean, would you agree that right now it's kind of bearish conditions to be mining?
Would I agree? Yeah, it's one. I mean, indisputably it is, right? Hash
Right.
price is super low. I think that equation changes a little bit when we start seeing the average network efficiency, shift down to the S21 and M60 series, right?
Yeah, definitely.
But then obviously, I mean, this, it's a
But
kind of
then, what
vicious
happens
cycle
next?
because
Yeah.
then hash price gets depressed even lower as difficulty continues to rise. Yeah, I mean, definitely bear right now, but if Bitcoin rips over the next year, it's certainly not going to be, post China mining ban margins where you had this kind of glorious window where Bitcoin was going up and difficulty was correcting because Chinese miners were unplugging.
Yep.
It'll be a little bit juicier, but it won't be anything like what we saw back then, probably.
Yeah, or maybe you want to, if you take the view there's going to be a power shortage, then you wait long enough and you just can't get any more megawatts devoted to
Right.
mining. And then you're just playing the ASIC game, but you're not competing against like new megawatts of ASICs at least. So
At
as long
least in the US. And
yes, that's true.
little selfish plug here, but our newsletter today was looking at hash rate growth, basically that led, what led to the new all-time high. Lot going on in the US, public miners like Riot deploying M20 or M60 and S21 series ASICs, but also a lot of activity popping off in Russia, and China is starting to wake up again. I mean, I don't think that people have priced in what would happen if China completely reversed course on the China mining ban. They've been deploying megawatts out the wazoo for their grid. I mean, they're building coal plants and nuclear plants all over the place. Maybe the Chinese government gets wise and decides to slap some Bitcoin miners on that and try to monetize some of that revenue. It's kind of a pipe dream scenario, maybe. But, all that being said, I kind of expect over this next halving epoch for the United States to kind of drain some of its hash rate share. And I think that's just going to be a natural consequence of not just other jurisdictions becoming more prominent on the stage, including in places like South America and and Africa, but also just the fact that they're going to be competing with these hyperscalers, these AI and HPC companies, and I think those companies are going to be able to outbid for the megawatt allotments that they need. So
Well, definitely. So, like, if you're running a mining operation and someone comes to you and offers you some, this is going back to the CoreWeave Core Scientific deal. They offer you some amount of money for it. You can do the math and see, the dollars per kilowatt hour you get from that deal, and then you can look at the dollars per kilowatt hour you get from mining. And then you also have to factor in, okay, if I'm mining, I'm going to have to also pay this ongoing capex of buying the new ASICs every so often. Otherwise, my revenues just decay and I end up having to, I have nothing. So you compare the two and then you see which one's better. And depends on your outlook for Bitcoin. If you think Bitcoin's going to be 500K in a year, then obviously, you're going to make more dollars per kilowatt hour mining in the long run. So I think there is some price where there's some algebra to do there. And right now, it's very strongly in the favor of HPC, at least based on the Core Scientific CoreWeave deal. And
right.
to the point of CoreWeave paying for that whole upgrade thing, I think that is somewhat reflected in the price. I think if you had a deal today where they don't pay for the upgrade and it's, the miner has to do it, or let's say the miner already has it, I think they'd be paying you more dollars per kilowatt hour for that capacity. So I think they sort of just like moved what they're paying from one thing to another. Like maybe they pay less monthly. They pay for the capex, but they pay less per month in just like the fee.
You're saying the CoreWeave in this scenario.
Yeah.
Yeah. That makes sense. And
But who knows? We're all still waiting for the next deal to crunch the numbers on that.
right.
See how
Yeah,
it
I know.
compares.
Honestly, I think the biggest, just again, the biggest question mark is just, and one of the things that I think we'll all be really paying attention to over the next year or two is how they actually execute on this. Because of course, Scientific pulls this off, it'll be the biggest comeback in the Bitcoin mining, industry, I think, to date. I want to go back to this. It is. I want to go back to this question because I realized, Cowboy Habibi, we actually didn't answer your question. And I guess to his point, like, mining stocks are tracking with Bitcoin right now. So like while mining profits are in a bear, the actual mining stock market is in a bull along with Bitcoin. So how much risk is there in hyperscalers buying them out during the bear? They can't be that dumb to buy at the top, can they? I wouldn't say it's dumb. I would say it's kind of, there's a race against the clock here, and you really only have a certain amount of time compared to, or you only have a certain amount of time to actually maybe purchase these assets and get HPC, fleets deployed and actually start cashing in on this, right? I mean, there's only so much electricity in the U.S. currently. They're restarting. Microsoft is basically has a deal that's going to restart 3 Mile Island with Constellation Energy. There are going to be a few things like that, but building out actual assets like a nuclear site to support some of these loads is going to take a decade in some places. So I think it's one of those things where you're kind of racing against the clock, and you don't really care if you're going to pay a premium if it means that you can be one of the first in line at the marathon. Do you agree with that, Penny? Is there anything that I'm missing there?
Yeah, I'm also a little just confused by the question. What's the risk? Are you afraid of someone buying out a mining company that you own? Because that's going to be a good outcome.
I feel like there's
Okay.
a lot of operators who would agree with you, Penny, on that.
Penny, the most bearish guy in the mining space, making review on earnings. What do we expect from him? Never anything positive. I would push back on that. I think Penny has been pretty measured here. I also like people. I mean, I don't know. You want hopium? Penny's gonna bring you objective analysis. He's not gonna, sprinkle fairy dust on your favorite stock to make
Yeah,
you
if I
want to
wanted
buy
if I
more.
wanted to be bearish, I'd point out, I guess I did point it out on Twitter, but year to date, the companies selling the shares of Riot, they get a commission. They've made more money than Riot the company has.
Sorry, say that one more time. I got distracted.
So Riot has selling agents for their shares, right? When they sell their shares on the market, and those selling agents get a commission. Those agents have made more cash than Riot has made cash from mining, which I think is,
That's
and if I wanted to be bearish, I'd point out, how much investment goes into all these mining, and then how much actual cash flow they're seeing right now. You'll never get your money back. But
Or even just
that's
reflecting on
all
the
a given.
past. Let me reflect
Yeah.
on the past year. Has the past year been super bullish for mining stocks? And the answer is not really. So if somebody was, preaching hopium 9 months ago, they would have led you a little bit astray. So
And this is just a perfect example of like the market can stay irrational longer than you can stay solvent. I feel like Bitcoin mining stocks are kind of the perfect litmus for that test, because at the end of the day, none of these fundamentals really matter if Bitcoin's ripping or if it's
Exactly.
tanking.
Yeah.
So there's still high beta plays. I mean, people were saying with the ETF, you're not going to see this as much. And I was arguing before the ETF launched, that's just not true, because you can look at mining stocks for silver or gold and the same thing happens. It's like anytime these commodities run, the people who produce them run as well, and at a higher valuation than they otherwise would. And you see the same thing with mining stocks. I mean, as
Yeah.
long as Bitcoin is mooning or tanking, you're going to see movements with these stocks in the same direction.
So I think the briefest way to say how I view miners is like, when Bitcoin goes up, the fundamentals do improve dramatically, because they're basically like perpetual options on Bitcoin. So obviously Bitcoin goes up, they're making a lot more money and their expenses are flat. So that's great. But when you actually like crunch the numbers to see where Bitcoin needs to go and what needs to happen for them to make an amount of money that's sort of commensurate with their valuation, then that's when it starts to get that's when I start getting bearish when I look at that, because it's a very long way away. And even if that does happen, we know what's going to happen. There's going to be hash rate's going to grow faster, and then it's just going to go back into a bear market again. And I don't know. So yeah, I admit it's hard. I have a bearish slant on pure play mining, but I think the way I covered Riot, save for a few comments, like when I was poked, I guess, has been pretty neutral. I've been trying to be neutral. I just called
I
the
think it's
numbers
been fair. I think you've been
and I
fair.
don't think it was bad. I don't think it was a bad report. It was a little, it is a fact that their SG&A costs are higher than the peers, and they did
Yeah.
improve their cost of revenue, and their SG&A went up less than their hash rate did on a
Right.
percentage basis, which is good. That's where they should be heading. So
100%. And you got to look at the bad with the good, right? So that's some of the bad. Some of the good, though, in praise of Riot, they have one of the lowest power costs in the entire ecosystem, and they also have one of the lowest efficiencies at 23 joules per terahash. They're at one of the top percentile there compared to their peers. So some good things and some bad things. Penny, we're running up at 2 hours here. Any final thoughts before we all split and go about our day?
Well, this is I'll ping you something later. No final thoughts. I mean, it was fun. I put in some hours today, like just going over the numbers of Riot to see how the predictions work out, and I think it was pretty cool. I got it pretty close. And it's nice to see nothing terrible was announced, and I don't know. I'd say there's kind of no huge surprises here, but it's been fun coming on here.
I would say so. And if you were looking at Penny Ether's Twitter feed, you would see that some of his predictions, some of his expectations versus the professional stock analysts at Zacks and others were closer. Penny, we really appreciate you coming on. This was great, man. Love the commentary. Where can people find you? Where can people find your work? Use this time to shill your bags.
I don't seek a big following on Twitter.
You should seek a big
Twitter
following.
or X. It's Penny_Ether.
The infinitely humble Penny Ether. Penny, thank you for joining us. Everyone, thank you for joining the stream. We appreciate y'all sticking with us. It was a pretty long call. Thank you for sticking around for the debriefing after the fact. We're going to be doing these for as many mining stocks as we can conceivably do over the next few weeks because all the earnings will be coming out. And if there's anything that you want us to, particularly any questions that you want us to field, anything you want us to dig into, please let us know. You can email me at colin@blockspace.media. You can find all of our work at blockspace.media, Mining Pod on YouTube, Spotify, Apple, all of those things. And yeah, that's kind of a wrap. Everyone have a good Halloween. Give out good candy. My wife bought Almond Joys. Don't buy Almond Joys. Kids do not want Almond Joys.
That is so true. That is
right.
We used to. They have like negative value. Can't even trade them for anything.
Right? So she came home. I'm sorry. This is the last little color at the end of this. She came home with Kinder bars, which are Bueno bars. They're very good. Very good. Hazelnut filled. They're from Europe. We love that. Butterfingers, okay, not my favorite. People like them. And Mounds and Almond Joys. And I was like, do you want us to get egged? This is grandma candy. This is one step removed from an apple. So anyway, don't give Almond Joys.
There's butterscotch grandma candy, which is awesome, and then there is Almond Joys grandma candy, which is terrible. Happy Halloween, everybody! Penny Ether,
happy Halloween, Penny. Thanks for joining.
Fun.
Y'all
Happy
have a beautiful
Halloween.
weekend.
Cypher tomorrow morning.
Oh, that's right. Oh, damn,
Yeah.
my day just got blown up.
I didn't crunch the numbers. I think I'm just going to take a pass.
Okay. Well, if you want to hop on, if you're not busy, let us know for the debriefing. Love to have you back on. Great conversation, great insights as always. And with that, peace, y'all. Have a good Halloween.
Deuces. Bye.